This is smart money concept, a strategy used by institutional banks, hedge funds, and of course, profitable traders use. In this video, we will cover everything from market structure, order blocks, fair value gaps, and many more. Without further ado, let's get into this video. Let's dive into the details of order blocks. In a bullish scenario, an order block corresponds to the last bearish candle before a strong upside move, leading to a bullish break of structure. Similarly, in a bearish scenario, an order block refers to the last bullish candle before a sharp downward movement that results in a valid break of structure. These zones are crucial as they represent areas of institutional activity where large buy or sell orders have been executed. The psychology behind these zones is that they often act as manipulation areas before significant price movements, making them high probability reversal points. By incorporating order blocks into our trading strategy, we can capitalize on potential trend reversals and directional shifts when price revisits these zones. To confirm a valid order block, there are essential criteria to follow. First, price must sweep liquidity, meaning it should break above or below the previous candle's high or low before initiating a strong move. Second, price must leave behind an imbalance, a gap between consecutive candles indicating inefficient price movement. Without this imbalance, the identified order block may not be valid. Third, order blocks must be unmitigated, meaning they are most effective on the first retest. Once an order block is mitigated, it is no longer considered a reliable area for future trades. Fourth, a high-quality order block must lead to a break of structure or a change of character, confirming a shift in market direction. To solidify our understanding, let's look at some real examples. In this first order block, this bearish candle takes out the liquidity from the previous candle's high, and a fair value gap forms in the following candles. Additionally, it remains unmitigated and is followed by a significant break of structure to the downside. Therefore, this qualifies as a valid order block. Examining the second order block, we see that the bullish candle sweeps liquidity from the previous candle's high. It also gets tested and is followed by a clear break of structure to the downside. However, due to the absence of a fair value gap after the order block, it fails to meet the full set of validation criteria. As a result, this is considered an invalid order block. Moving on to the third order block, we observe that a fair value gap has developed. It remains unmitigated and is followed by a distinct break of structure to the downside. However, the bearish candle fails to sweep liquidity, indicating a lack of the necessary liquidity grab. As a result, it should not be considered a valid order block. Shifting to the fourth order block, this bearish candle sweeps liquidity from the previous candle's high with the formation of a fair value gap in the subsequent candles. Moreover, it remains untouched and is followed by a notable break of structure to the downside, confirming its validity as a strong order block. As a result, the price respected this level and continued its downward movement. Looking at the fifth order block, the bearish candle sweeps liquidity from the previous candle's high, confirming the presence of institutional activity. A fair value gap forms in the following candles, and the level remains unmitigated, adding to its strength. Additionally, the price experiences a clear break of structure to the downside, validating this as a strong order block. As a result, the market respected this level, leading to a continuation of the downward movement. Moving on to the sixth order block, the bullish candle sweeps liquidity from the previous candle's high. However, due to the absence of a fair value gap, a change of character, and the fact that it has already been mitigated, this order block is considered invalid. Moving on to the seventh order block, none of the criteria are met. Therefore, this order block is considered invalid. As a result, the price is unlikely to respect this level significantly. Moving on to the eighth order block, this bullish candle takes out the liquidity from the previous candle's high. Additionally, it remains unmitigated and is followed by a significant break of structure to the downside. Although there is a gap between the following three candles, the third candle lacks bearish momentum, making the fair value gap invalid. As a result, this qualifies as an invalid order block. Moving on to the ninth order block, this bullish candle sweeps liquidity from the previous candle's high. It also remains untested and is followed by a clear break of structure to the downside. However, the absence of strong bearish momentum renders the fair value gap invalid. Consequently, this does not qualify as a valid order block. Before exploring the fundamental and advanced aspects of fair value gaps, it is essential to first understand market sentiment and the underlying psychology that drives price movements. Market dynamics are primarily influenced by two key factors: liquidity zones and fair value gaps. The market is constantly in search of liquidity to fuel its movement, making it a crucial component of price action. Another major factor is fair value gaps, which the market frequently revisits to correct price inefficiencies. For instance, when the price experiences a sharp increase, it often creates an imbalance, also referred to as a fair value gap, which the market tends to fill before continuing its overall trend. This repeating cycle, where the market sweeps liquidity and fills fair value gaps, forms the foundation of how price moves. Now, let's explore how to identify fair value gaps from a candlestick perspective. They typically form within a 3-candle sequence and are noticeable as large candles where the upper and lower wicks of the neighboring candles do not fully overlap the body of the middle candle. This gap, or fair value gap zone, is the space between the wicks that the market tends to revisit. To effectively utilize fair value gaps in trading, it is crucial to follow a set of key principles. First, for a fair value gap to serve as a valid trade entry point, the price must exhibit either a break of structure or a change of character. Without these confirmations, executing trades based on fair value gaps is risky, as they are essential indicators of whether the market will continue its trend or reverse. Second, traders should focus on fair value gaps based on market direction. In a bearish market, priority should be given to fair value gaps located in the premium zone for short positions, while in a bullish market, traders should target fair value gaps in the discount area for long trades. Third, fair value gaps found at market extremes hold greater significance for trade execution compared to those in the middle of a range, as they tend to provide stronger reactions and higher probability setups. Lastly, unmitigated fair value gaps are most effective on their first touch, making them one-time use zones. Once a fair value gap has been mitigated, it loses its effectiveness and should no longer be considered a high probability trade area. The theory behind fair value gaps is based on market structure and liquidity behavior. When a strong bullish structure forms with high momentum and minimal selling pressure, traders who miss the move often place buy limit orders near key zones like order blocks and demand areas, anticipating a retracement. This accumulation of pending buy orders creates a liquidity pool inside the fair value gap, making it highly probable that price will return to fill the gap before continuing its trend. These gaps act as a magnet, attracting price to rebalance before resuming its momentum. This provides traders with high probability trade opportunities, as price often mitigates these gaps before continuing in its original direction. In a bearish scenario, a fair value gap, also known as a liquidity gap, forms when the price experiences a sharp downward movement due to the absence of buying pressure. When identifying a fair value gap, traders should focus only on the impulse candle and its adjacent candles, while disregarding other candles outside this range. The liquidity voids created by these gaps hold significant importance, as they often act as entry points due to the market's tendency to be attracted to liquidity. When the price moves downward, it seeks to clear potential liquidity pools above, leading to temporary bullish retracements before ultimately filling the gaps and continuing the bearish momentum. To use a fair value gap for predicting market direction, traders should closely observe price action when it enters the fair value gap. If the price respects the fair value gap and rejects to the upside, it suggests that the price may aim to reach the most recent buy-side liquidity above a previous high. Conversely, if the price fails to show a reaction upon reaching the fair value gap, it is more likely to continue downward, targeting the sell-side liquidity below a previous low. Let's take a look on the real chart example. On the first one, this bullish impulse candle breaks structure to the upside, leaving behind a fair value gap in the subsequent candles. Moreover, it remains unmitigated and is positioned in the discount zone, aligning with the overall bullish market structure. Additionally, the fair value gap forms at a market extreme, increasing its probability of a strong reaction. Therefore, this is a valid fair value gap. Moving to another example, the price continues to break a key high, creating a fair value gap in its wake. Furthermore, it remains untested and is located in the discount zone, aligning with the broader bullish market structure. Additionally, the fair value gap appears at a market extreme, enhancing the likelihood of a strong price response. However, Due to the absence of strong bullish momentum in the third consecutive candle, this is not considered a high probability fair value gap. Now, let's move on to the next chapter, which focuses on market structure. In a bullish market structure, identifying strong and weak structural points is essential for understanding price action dynamics. A strong low is created when the price breaks a structure to the upside, confirming bullish momentum. As the market trends upward, multiple breaks of structure occur, forming consecutive strong lows that serve as critical support levels. In this example, we observe the price consistently breaking structure to the upside, reinforcing the presence of strong lows. However, within this bullish framework, weak structural points also emerge. A weak high is formed when the price fails to break below the most recent strong low. For instance, after a break of structure and the formation of a strong low, the price retraces but does not violate this support level. Instead, it initiates a pullback, leading to the creation of a weak high. Once this weak high is broken, a new strong low is established, reinforcing the bullish trend. The cycle continues as the market respects strong lows while invalidating weak highs, confirming the uptrend strength. Let's move on to the bearish scenario. In a bearish market structure, recognizing strong and weak structural points is essential for understanding price movement and trend continuation. In a downtrend, the market forms a series of lower lows and lower highs, confirming sustained selling pressure. When the price breaks structure to the downside, it creates a strong structural high, reinforcing the bearish momentum. At the extreme, a strong high is established when the price fails to break above a key level and then retraces downward. As the price moves lower, it creates a weak low, which becomes a vulnerable point for further breakdowns. Once this weak low is broken, a new strong high is formed, strengthening the trend. The pattern continues as each pullback fails to break the most recent strong high, resulting in the formation of another weak low. Every break of structure to the downside establishes a new strong high, confirming the continuation of the bearish trend. Analyzing this chart through the lens of bearish market structure, we observe a clear downtrend, characterized by a sequence of lower highs and lower lows, confirming sustained selling pressure. As price breaks structure to the downside, it establishes strong structural highs, reinforcing the bearish momentum. As the market moves lower, it creates weak lows, which serve as vulnerable points susceptible to further breakdowns. Once a weak low is breached, a new strong high is formed, further strengthening the trend. Moving on, price makes another break of structure to the downside. It forms weak lows, which act as fragile support levels that are prone to further breakdowns. When one of these weak lows is violated, the market establishes a new strong high, reinforcing the downward trend. This cycle continues, where each pullback fails to break the previous strong high, leading to the creation of another weak low. With each break of structure to the downside, the market confirms the continuation of the bearish trend. Examining this chart, we identify a clear uptrend, marked by a series of higher highs and higher lows, indicating strong buying momentum. When the price breaks structure to the upside, it creates strong structural lows, reinforcing the bullish direction. As the market advances, it forms weak highs, which act as potential breakout points. Once a weak high is surpassed, a new strong low is established, further confirming the trend. As the price experiences another break of structure to the upside, additional weak highs emerge, serving as temporary resistance levels that are likely to be broken. When one of these weak highs is cleared, a new strong low is formed, reinforcing the continuation of the uptrend. This pattern persists, with each retracement failing to breach the previous strong low, leading to the formation of another weak high. Each successive break of structure to the upside further validates the bullish trend and signals continued upward momentum. That wraps up today's video on smart money concepts. If you want to know more about head and shoulder strategy, make sure to check out this video. Thanks for watching, and I'll see you in the next video.